The key to saving taxes, not today or tomorrow or this year, but over a lifetime and beyond to your beneficiaries, is my number one always rule. Always pay taxes at the lowest rates.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Smart retirement planning is key to living well after you've stopped working, but sadly, many Americans find themselves falling behind. According to the Federal Reserve's Economic Well-Being of U.S. Households report, 65% of Americans either believe their retirement savings are off track or they aren't sure. And for those who do have retirement accounts, the median savings balance stands at just $87,000, far too little to retire on. Today's guest is going to tell you how to increase your odds of not only being able to afford to retire, but doing so with ample access to live your golden years the way you want. Ed Slott, CPA, is a renowned IRA distribution expert, author, and professional speaker known as America's IRA Expert. He's the founder of Ed Slott and Company, creator of the Elite IRA Advisor Group, and a professor of practice at the American College of Financial Services. He focuses on advanced tax strategies and retirement savings. Ed, thanks so much for joining us today.
Thank you. Great to be here. When you mentioned that median retirement balance, 80-something thousand dollars, I wonder, is that skewed to like all ages? Because I would think somebody like in their 50s or 60s would have a much higher median.
You would hope. I don't have the distribution in front of me. I think that is probably median of all working adults. So maybe that
sounds pretty weak.
Yeah, but I have seen data that shows it's not all that much better for people who are in the 54 to 64-year-old cohort. You know, maybe they've got 175,000, maybe 200,000, but again, that's not enough to fund the next, 20 plus years of your life.
Yeah.
All right, Ed. So, look, as far as thanks go, thank you again for coming on. But
Oh, great.
extend my gratitude to the team at Lance Roberts' teams at Real Investment Advice. They had me out at their conference in January where you were the keynote speaker.
Yes.
And really enjoyed your presentation and
Thanks.
thought I wanted to get this in front of my audience. So that's what we're going to try to do today.
Okay. Now you remind me what I said because it's different every time.
Yeah.
As you saw with me, I never use PowerPoint or slides or anything. It's whatever happens organically with the audience.
Good. Well, we'll build into this nicely, Ed.
Yeah.
So to start, let me ask you this. What are the most common mistakes or acts of self-sabotage that people make when it comes to retirement planning?
Oh, the number one mistake, short-sightedness. That's easy, especially when it comes to a Roth IRA or more particularly a Roth conversion. A Roth conversion requires you to pay tax up front. And one of my always rules, the reason I created all these always rules I have of mine, because I saw for years people on TV, talking heads and everything, not me, they could never give you a straight answer. You'd be on CNBC. They said, well, probably, could be, maybe, I don't know, wishy-washy, have to run the numbers. And to me, that didn't help anybody. So I came up with my own. There's not many of them because there's not many rules that are always. But when I tell you I have an always rule, you can take it to the bank. It's non-negotiable. And the key to saving taxes, not today or tomorrow or this year, but over a lifetime and beyond to your beneficiaries, is my number one always rule. Always pay taxes at the lowest rates. Now that sounds simple. It makes sense too. If you're always paying at the lowest rates, you'll save the most in taxes over a lifetime. But there's a second part to my always rule, which catches people. Always pay taxes at the lowest rates, even if that means paying taxes before they're required. Uh-oh. And that's the one that nobody likes, because nobody likes paying taxes before they're dragged kicking and screaming. I'll give you an example. Let's say you're a 60-year-old. Now, a 60-year-old, you're building a nice retirement account maybe, and under today's law, you don't have to take RMDs until age 75. It's actually 73 now, but for a 60-year-old changes later on. But for a 60-year-old, it's age 75. Should that 60-year-old, that's 15 years, should that 60-year-old do nothing for 15 years? Just watch this account grow. It's growing tax deferred, your IRA, a 401k, while there were low tax rates each of those years where some of those funds could have been pulled out, had historically low rates. And I'm not talking about pulling it out to spend on a vacation or something. I'm talking about like a Roth conversion, getting money out while rates are low. Taxes are historically low. And the Roth conversion is really just a big bet on future tax rates. So I may have asked the audience this, how many people think tax rates will go up? And almost all the hands went up.
Hmm.
But then I asked a different question, which is actually the same question, and no hands went up. I said, how many of you think taxes will go down? And nobody thinks that. And it's the same question. So I think the Roth is a good bet. But back to your question, what's the number one mistake people make that affects them long term? Short-sightedness, not seeing the big picture, where you want to end up. That may require you paying some taxes if you can get it now while rates are low, not using the 12%, 22, even 24%. If you don't maximize or optimize those brackets each year, they're gone forever. You never get them back. So back to that 60-year-old. Can you imagine wasting 15 years of low brackets?
All right, so let's define a couple of things here for people, Ed. So you're clearly a really big fan of Roth instruments,
I'm a
Roth
fan of
IRAs.
keeping more money and more of it tax-free. And any way to do that, which the best way, I mean, let's face it, the Roth IRA is the best account ever created. It grows tax-free for the rest of your life and 10 years beyond. It would be even better if you didn't have to pay the tax to get in there. But
Right.
that's the price of admission.
Okay, let me just again clarify here. So it grows tax-free, which is why you love it, but I think you love it even more because you withdraw tax-free on the back end. Unlike a traditional IRA where you're putting it in tax deferred, it's growing tax-free, but then you're actually getting taxed on it when you're taking those distributions, correct?
Right. And every year you watch this IRA grow, it looks nice on your statement, but it's also looking nice on Uncle Sam's statement too, because he's a partner in that growth.
All right, so uh, you, you you said don't
Never waste a low tax bracket.
never waste a low tax bracket. So I want to use your 60-year-old
Yeah,
person. Okay. So you're right. Most people think in general the tax code's going to go up over time, right? That's the
tax
assumption.
rates. Yeah.
Yeah, the tax rates. Um, but let's say that 60-year-old's still employed, and let's say
Yeah.
he's doing really well, right?
Yeah.
So let's say his income tax bracket, he's in the highest tax bracket right now. Um, the question here is what's better for me? Is it better for me to do a Roth conversion, and we'll define what that is in just a second, and take the tax hit on that today, even though I'm in the maximum tax bracket, and I might be in a lower tax bracket later on when I start doing my distributions. But hey, that still might make sense to take it today if I've got enough years of growth ahead of me that if I'm taking it out tax free, yeah, it's worth the hit today. So how does somebody do that math?
That's a tough one because if you're in the top bracket, you're probably thinking I'll be in a lower bracket in retirement. But in reality, the math isn't proving that out. Now there could be a situation. We've seen situations where there was a gap, a lag, where somebody in their 60s, they're doing well at their top earnings year, top bracket, like you said, but they retire maybe at 67 or 68. So you have those few years where income will be lower before RMDs kick in. Those would be the years to fill up those low brackets. Also, I might still do the conversion if you look at where he may be, this person, when RMDs are required,
Hmm.
are required minimum distributions. Because one of the real benefits of converting to a Roth IRA is known tax rates. We know what the rates are today. We don't know what they'll be when the 60-year-old retires. Plus, if he does nothing, to me, doing nothing is not really an option unless you honestly believe you'll be in a lower bracket in retirement. There's a lot of people who will. Then the Roth conversion probably doesn't pay. Going back to my rule, always pay taxes at the lowest rates. If you think you'll be at low rates in retirement, then fine, then you'll be fine, and the beneficiaries too. But many people, when they do whatever analysis they do, whether they use computers or however they do it, they fail to take into account that when they do nothing, if they say, well, I'll be in a lower bracket in retirement, so I'm not going to do anything. And now you have this 60-year-old growing for 15 years, a gigantic tax bill. If you have large balances, that's another factor too. If you have too much in your IRA, what do I mean by that? Many people have an imbalance today, especially people with large balances. Not everybody has that, unfortunately, but if you have 500,000 or a million and more in an IRA, you have too much money in your IRA as compared to tax-free money. There's an imbalance because most people, the Roth came later, so most people filled up the tax deferred. So they have what I call tax risk diversification. They have they don't have tax risk diversification, is what I'm saying. They have too much that will be taxed later. So if this continues to grow, you may only be looking in retirement when you say, what will my bracket be? You have to figure out the cumulative effect or the accruing of RMDs, what they will be based on 15 more years of growth when you didn't touch that money. So now what we see in the real world, I've seen it with clients when I was a practitioner, and we would see people come in. And I remember this one guy, I was having this exact conversation with him, a tax client right at this desk, same desk I've been at for over 40 years.
Hmm.
And I was talking to him about Roth IRAs, and he says, no, everything you said. I'm in a high bracket, making a big W-2. I'll be in a lower bracket in retirement. All right, and this was almost a joke already, all the years of these little talks while we were doing the tax returns. So he comes in this one year, and he's licking his chops almost. He says, Ed, no W-2 this year, totally retired. I give him the return. How could this be? My income's higher than my best earnings years. How could this be? Because you never listen to me. Now your IRA is so high, your RMDs exceed the income you used to have. And you didn't figure on that. So, and the RMDs, remember the R stands for required. Then it's
Right.
out of your control. While you're converting to a Roth, I'm not saying convert everything, you're in control. You can manage the brackets. But once RMDs kick in, those funds have to be taken at whatever the future rate is. And we don't know. That's another unknown. If you know the rates now, and they're super low now, historically low for most people, even people like that in a high bracket, the highest bracket is 37%. Compare that to what it was in the 70s and in 80s, of 50%, 70%. I'm hoping we don't go back to those days. But I also have to look at the math. Not that Congress does, but I look at it, and you see the debt level. I don't know what the debt levels are, 37, 38, 39 trillion. All I know is if they have to round up to the nearest trillion, that's a problem. That's a financial problem. And the things I'm saying where I believe tax rates will go up, I've been saying that for years and I've been wrong. But I have to believe at some point the math has got to hit the fan. So if you can lock in these rates, it might be a great deal, but it's not for everybody. So if you truly think you'll be in a lower bracket in retirement, then it's not for you, or you do partial. One way to go into the midway of this whole situation is to do a series of smaller conversions each year for that 60-year-old for maybe 15 years, using up some part of the bracket just to hedge your bets. At least get something in the Roth at low rates just to manage the imbalance of IRAs to Roth IRAs.
All right. So again, let's I want to dig into your advice about managing the brackets and helping people understand that. But before that, so again, you're a big fan of anything that lets you reduce your taxes, and you love tax-free more than anything.
Reduce lifetime taxes, not today's taxes, because
Yeah.
we're in tax season today. And I guarantee there's somebody listening, either they're doing their taxes or sitting with their accountant. I say, should I convert to a Roth? And the accountant, my own peers, will say, oh, no, that's going to raise the tax bill. That's going to raise the tax on Social Security. That could knock out the new senior deduction. Oh, that's going to raise your IRMA charge. All right, I heard enough. I'm not going to go near a Roth. But that's 1 year. You're not thinking long-term, big picture.
Okay, so minimizing lifetime tax payments.
And for beneficiaries, remember, when people say they'll be in a lower bracket in retirement, I've had people tell me that I'll be in a lower bracket in retirement. I always answer, there's no I in team. Maybe you think you'll be in a lower bracket, but let's say you're the husband and you die, and now you leave your IRA to your wife. You never did the Roth conversion because you figured you'd be in a lower bracket. Well, now something I call the widow's penalty that people just don't plan for. And what happens is most couples, which is fine, most couples leave everything to each other, and that's fine. But when the husband dies, let's say in this sense, in this example, he leaves everything to his wife. So she's going to have the same income, roughly, maybe a little less due to the Social Security adjustment. She's going to have the same income that they both had together. But she will be paying tax at a much higher rate because now she's filing at single rates. I'll give you an example. If you want to look up the tax rates for 2026, and a married couple filing joint, let's say they had 400,000 of income, they'd be in the 24% bracket. A single person would be in the 35% bracket. That's a 46% tax increase on that widow now. And that's going to hit her for the rest of her life. On the other side, let's say he converted everything. Maybe he thought he'd be in a lower bracket, but he wanted to make sure his wife wouldn't get hammered with taxes at single rates to avoid the widow's penalty. And let's say just extreme, he converted everything. Well, now he dies. She has a Roth IRA. Her income will be low for the rest of her life and 10 years beyond to beneficiaries. Plus, she won't be required to take any money out of that Roth because Roth IRAs have no lifetime required minimum distributions. Plus, if she wants to take money, she can, total freedom. It won't increase her income. It won't increase the tax on her Social Security or the Medicare IRMA charges or the 3.8% tax on net investment income. She can just take the money tax-free. If she doesn't take it because she doesn't need it or for whatever reason, she can leave it to the beneficiaries who, even after the Secure Act changes, can hold on to that money, growing, building, and accumulating 10 more years, all income tax-free for the investment, say, the husband made when he decided to convert. So you get the bang for your buck. It's just the buck has to come out up front, and that's a major psychological hurdle for most people.
Yeah. And we're going to get to how to deal with that in a little bit. You just said something I want to confirm. So Roths do not have RMDs?
No, lifetime RMDs. For beneficiaries, there are. For most non-spouse beneficiaries, they have to empty the inherited Roth by the end of the 10th year after death. But they don't have to touch it for 10 years if they don't want. So it grows and accumulates, snowballs, like I said, income tax-free for her life and beyond to the to the children or grandchildren.
Okay, so just to be clear though, I put my money into this Roth while I'm alive. I don't have any RMDs. If I die and
Never.
give it to and I die and my spouse gets it, she doesn't have any RMDs.
No.
It's only when the estate then passes to heirs, they've got 10 years to take those RMDs.
Right, but look at the amount of time, given most people's average life expectancy, the accumulation period could be decades.
Right, you really benefit from all that compounding and appreciation. Okay, so that's a huge advantage there. Even I wasn't super clear on. Okay, but again, just getting down to brass tacks, I'm going to build up a little bit here.
All right.
Okay, so first off, you love minimizing lifetime taxes. The Roth is a great.
Everybody loves minimizing lifetime taxes.
Okay.
The difference is I don't mind paying for it up front, and that's the secret to it.
Yeah.
I'm going to give you the secret to this. You know what Benjamin Franklin said about secrets? Three people can keep a secret if two of them are dead.
Right.
Here's the secret, and I use this in a lot of my consumer programs. 3 words to paying the least amount of taxes over your lifetime on your retirement savings. 3 words, pay taxes now. Now, when I say that, most audiences say, Ed, What kind of accountant are you? Pay taxes now. If I pay taxes now, I'll immediately have less, not more. I'm here to tell you, if you get it out at the low rates, the exact opposite is true mathematically.
Okay, and I understand the sense of that, and I think a lot of my audience probably rationally does. Maybe they're still working through the emotional challenge of
It's
writing that
a
big
it's a
check today.
psychological. I said it's a major hurdle to pay a tax, especially when your accountant is there. And I'm an accountant too, but you know what? I'm a little different than most I'm a recovering accountant because most accountants are just there to help people. They just look at how do I save you taxes this minute? Yes, you could save a boatload of taxes and just kick the can down the road like Congress does.
Yeah, and one of the reasons why I've brought you on is I've learned of some instruments like this where I'm like, why didn't my accountant tell me about this? Because it's going to save me a lot of money in the long run, and usually it's because in the short run it's costly. Um, and they have that short-term focus, like you're saying. But okay, so the goal is to minimize lifetime taxes spent. The Roths are a great vehicle for that. Now, Roth IRAs, first off, there's just a minimum, sorry, there's a maximum that you can generally put in each year. And there are income limitations on it, correct?
Yeah, that's not what I'm talking about. That's the small potatoes. I'm talking
Yep.
big picture. Roth contra. There's two flavors of Roth: contributions and conversions. I'm
Right.
talking about the big number, the
I know, I
conversions.
know. I just want to make sure people sort of understand the options that are out there.
Contributions are limited by income. For example, for 2026, the most you can put in is 7,500. If you're 50 or over, another 1,100, so it gets you to 8,600. And that's assuming you're under the Roth income limits. And if you are over that, there's something called the backdoor Roth. But that's seven, eight, nine, that whatever it's going to come
Yeah.
to with the inflation increases. That's small potatoes. Again, I always plan in the big picture. Where do you want to end up? That's great doing that if you can. But the big picture is bringing down this IRA. You have to start reducing these heavily weighted IRA balances while rates are low.
Yep. So I agree with them, and I'm just building here. So
Oh
first
boy, I
off,
can't wait till the finale comes.
no worries. And we're just in the introduction right here. But if you can, if you qualify to be able to put those contributions in, I assume you would say do it.
Yeah, because all
Okay.
you're doing it is moving money from one pocket to another. It's your own money. You're moving money from a taxable pocket to a tax-free pocket.
Okay, great. So we're doing that now. Um, now we're going to talk about the Roth conversions in just a second, but above and beyond contributing to my Roths, if I can then put money into something like a traditional RIA or whatnot, I should do that, correct?
Well, it depends. Again, I'm a little controversial in this area. I think some people are heavily overweighted. Like I said, no balance. They don't have any tax. They the tax risk. With investments, they tell you don't put all your eggs in one basket, everything in one stock. But people are doing that with their IRAs. They have all their IRA money in one tax basket, and that basket is too full. So if you think you're too full and you want to build up in the tax free, why would you add anything to that problem if you're already at a problem phase?
Okay. And just so you know, I'm coming at this as from the perspective of somebody kind of growing into their career, right? So
Yeah,
so so I would assume you would say put your money into your Roths first,
right.
then put your money into your traditional IRAs
Well,
up
it
until the
depends.
point where you start having too much.
Well, even before that, I might stop. I would look at your tax rates. Again, tax rates are historically low. From a tax planning perspective, you want to you want to take deductions when rates are high, not when rates are low. So
Hmm.
getting a deduction for an IRA or 401k contribution, it's not worth it when rates are low. You take income when rates are low, you take deductions when rates are high.
Okay. All right. Yeah, that does make sense to me. And maybe somewhere in here too, I should probably just say getting a good financial partner, a good accountant, a good financial advisor who can kind of help you do the math to judge when it's too high, when it's not, will be helpful. Um, all right, so let's talk about a Roth conversion now, which essentially is a way to take tax deferred retirement income and put it into a Roth. But then the challenge is you have to pay the price of that up front. You have to pay the taxes of that. It's essentially a distribution, right? You have to pay that up front, right?
Right. Don't think of it as a payment in tax. Think of it as an investment in your future financial security because it goes right back. Yes, but it goes right back to you because this is tax that will have to be paid anyway. It's not if, but when. It's
Hmm.
not like if you don't do it, you've escaped it. The problem just gets worse and worse. Like, not seeing a doctor for a while. It doesn't mean you're getting better just because you didn't see the doctor and he didn't give you the bad news.
Right, right. And so here's the way I think of it, the benefit of a conversion, which is, and I'm going to take my high earner example.
Yeah.
Let's say I'm 50, right? And I'm successful, I'm in the highest tax bracket, but I hope to live another 40 plus years, right? So I've got, just to round numbers, I've got $1 million in a traditional IRA or amongst my traditional tax deferred retirement accounts. But let's say it's in one, just for simplicity. I've got $1 million in there. And I say, I want to do a Roth conversion. First question is can I convert all 1 million in 1 year?
Yeah, sure. If you have the money to do it, that's really ripping the Band-Aid off. I might
Yeah.
do a series of smaller conversions to use up the low brackets each year.
Okay. And so, all right, but you can't. First question is you can, in theory, take an unlimited amount that's in
Yes.
a retirement. Okay, as long as you can have the ability to pay the tax that year.
Right.
I'm going to come back to your brackets in just a second. But in my example, I'm 50. I've just paid, what's the top bracket? 37%, you said?
Yes.
Okay. And I guess it's gradated, so I'm not paying
No, not
370,000 of
everything's
it.
at 37%. Remember, I'm looking at the brackets now. The 35% tops out. It's a very high number. The brackets are so wide, you don't get to 37% married joint until your taxable income after deductions exceeds 768,700. So that's not most people.
Okay, got it. All right, but I'm paying my hefty fee. Let's just for
Yeah.
ease of calculations, let's say it's $300,000. Might be less,
Yeah.
but let's just say it's $300,000. So I'm paying that today on $1 million. Um, why would I do that? Well, in my mind, it's because, all right, fast forward 20, 30 years or more, that million will have grown to, I don't know, what do you want to say? 3
It
million, 4
doesn't
million?
matter what it grows to because now you're getting to an area which even my accounting colleagues, my CPA colleagues sometimes use what you're talking about as an argument against the Roth. Here's what they're talking about. You're talking about the time value of money, or what some people call the opportunity cost. So some people say to me, Ed, again, short-term thinkers, say, Ed, why would I convert and pay all that tax when I could have used that money to invest and it would have grown in the market? So I lose the opportunity. It's an opportunity cost. So
Hmm.
for anybody thinking that, and that's something like what you're talking about, there is no opportunity cost because you can't go about how much you make because you have to compare apples to apples. If you're doing the comparison, you have to you have to assume the same tax rate and the same earnings rate. You may want to write this down. I'll give you a little example to prove this point.
Okay.
Let's say you're debating whether to convert $100,000 or not. And we'll put on our parameters. So where you started going with that, but I would earn all this money, you have to assume even if it was in the IRA, you would earn all that money and it would be tax deferred. You would actually earn on a higher balance because you didn't use that money to convert to a Roth. So you can't assume because you went into a Roth, you'd earn more you, because you paid tax up front. So let's say you're debating, should I convert 100,000? All right, let's assume a 30% tax rate. Doesn't matter as long as you're comparing apples to apples, assuming 30% now and 30% later. And let's assume it doesn't even matter what your investment return rate is, as long as you're assuming it would have been the same in the IRA as it would have been in the
Hmm.
Roth IRA. So let's say instead of an investment return over many years, it would have doubled. All right, make it easy. All right, so if I don't convert, let's take the first scenario. If I don't convert, I have 100,000. I said the money doubles over time till you take it out, let's say. So now it'll be worth 200,000. And then I'll pay tax at the 30%. 30% times 200,000 is 60,000. So what does that leave you from the 200,000? If you're writing the
Well, that
number.
would be 140,000, right?
All right, good. I wanted to hear you say it. Okay.
Okay.
Now, all right, so that's one scenario. So I'd net 140,000, right? Let's say I converted now. I have the same 100,000. I convert. So now I pay 30% tax on the 100,000 right off the top. So now I'm only left with 70,000 to invest, but it doubles over time. What am I left with?
All right, 140,000.
It's the same thing. So you can't assume where you started going, say all this money will grow in the Roth like if it wouldn't in the IRA. The only difference is the tax, that 30% will apply to a higher balance in the IRA eventually.
Right. That's actually where I was going, which was
Yeah.
assuming they both grow at the same rate. My point was that the tax burden that I'm paying on day one, if this thing over time continues to grow, and like I said, 30,
Yeah.
20, 30 years, it's probably going to more than double. And
Yeah.
therefore, my tax deferred taxes that I will pay when I finally get to the distributions that I have to take will likely be far greater, even inflation adjusted, than what the hit I'm taking today is.
Yeah, they will be far greater, even though we're using the same rate and rate of return, because the difference is, and this is where I think the Roth tips the scales, you're forced to take that money out, whether you want to or not, at age 73 now.
Right.
With the Roth, it just keeps growing until you die, the spouse dies, and the kids 10 years later.
Right. And to your earlier point too, there's just a lot of uncertainty about the future, right? We might have President Mamdani by the time, I retire, and tax rates could be in the 70 percentile for whatever. Whereas in the Roth, you do have certainty, which is, hey,
Well,
when or even
today's
if I take
rates.
these distributions out, I know I'm getting it tax free.
Right. You have known rates. You know, it's really, like I said, a big bet on where you think future tax rates are. So when I say the word bet, it reminds me of a casino, which, by the way, I don't know if you've noticed this. I know you speak at a lot of financial conferences, me too. And they always teach you, have good speakers on how to be prudent with money. And most of those conferences are in a casino in Las Vegas or somewhere. So
Yeah.
I never understood, a little ironic, but
Yeah.
anyway, so the Roth is a big bet. Now, let's say you were in a casino, and I'm not a big, I don't gamble at all, but I've walked through I know the games, let's say. And let's say you're playing blackjack. In other words, on the Roth bet, you're betting, which I think is a real good bet, that future high, to do the Roth, it would work if you believe your future higher tax rates, the rates and your marginal rates will be higher. I think that's probably for most people, could be 70, 80% probability that it'll be higher. It's a good bet. So in Las Vegas, you don't get those kind of odds. But what if you did? What if you're at the blackjack table and you know the way that works, they have the two cards. What if the dealer turned over both of his cards before you decide to hit? Would
Right.
you increase that bet?
Absolutely.
Right. That's the same thing with the Roth. I think the odds go in your favor on whether tax rates will be higher in the future.
All right. And I like that analogy because the Roth gives you greater clarity, and that's just like being able to see both of the dealer's cards.
Right.
Okay. So earlier you said you want to manage the brackets.
Yeah.
So let's use my 50-year-old again. So somebody with some life ahead of them still. How do you manage the brackets?
Well, right now you gave an example of somebody already in the top bracket. Well,
Right.
it may not be the best thing for them unless they're so overweighted. I think in your example, the guy said already had $1 million. That
Right.
might be too much. Again, there's no disparity. There's no too much in tax. Instead of calling it tax deferred, to be taxed money is growing.
Okay.
You're growing a bill. I always say at conferences, your IRA is an IOU to the IRS. It's a growing building tax bill where the compounding is working against you. In the Roth, it's working for you. So when I say the tax brackets, you look at the brackets And I would say at a minimum, given today's 12%, 22 and 24, those are historically low. I know I've said it a few times, but most people don't realize how good they have it. And each year, the brackets, these low brackets, expand due to inflation increases. So more money can come out at 12% or 22%. I remember at an accounting conference I was speaking at, one of the accountants came up to me proudly. He was waiting for me to give him a pat on the back. He
Hmm.
says, Ed, you're going to love this. I kept my client in the 12% bracket. I said, I'm sorry to hear that. You mean the guy has a large IRA and you didn't use the 22 or 24% bracket? Now it's lost forever. So you
All
look at the
right.
brackets, you want to optimize. If you don't optimize these low brackets, and they are historically low, I know everybody complains about taxes and nobody wants to pay them before you have to. But I mean, this is like Christmas. It's on sale. Taxes are on sale. Look what they do on Black Friday. Everybody tramples over everyone to get a TV for $10 less because they like a sale. Taxes are on sale. And these are taxes. The difference with the TV in the store on Black Friday, you don't actually have to buy it. With the taxes, you do. So
You
with
do.
the taxes, you know you have to pay it at some point. So may as well get it on sale.
So yeah.
That's another way of saying my always rule. Always pay taxes at the lowest rates.
All right. And maybe this is really defined by the individual, but let's say somebody is in the 12% bracket, but they have money in a to be taxed a
Yeah,
retirement
right.
vehicle.
An IRA, yeah.
Is it just getting the next bracket? Is that what you want to do, or might you want to get
Whatever
the
you're
next two
comfortable with.
brackets?
It
Or
depends on how much you have. If somebody has, I'd say two, three, 400,000. I'm not saying that's not a lot, but it's more likely more of that money will be spent over a given life expectancy or through RMDs, and maybe a Roth is not a big deal. You may always be in a low bracket, just in lifetime spending and always getting it out. So this wouldn't apply. But as the accounts grow, the larger the account balance, it's not only a bigger tax bill that again will be forced on you at 73, but a bigger tax bill for your beneficiaries over that shortened 10-year window, because they may at that point be in their own highest earnings years. And all of that money, think about this, all of the buildup in your lifetime plus 10 years has to come out at the end of the 10th year after death to your beneficiaries. In other words, in year 10, it's a 100% RMD.
Mhm.
That could be a big hit of taxes at that point.
Okay, so help me understand here. So I get all the advantages of doing this. Um, uh, Now, the older you are, you may have less time to recoup
Yeah,
between the time you pay the tax and the time you have to start taking the stuff out. So a lot of people who are watching this video are close to retirement age or perhaps already retired. How should they be thinking about this? Because
well,
you can still kind of play these brackets even if
yeah,
you're
but
retired
no.
before your
First of
RMDs, right?
all, another one of my general rules: nobody should go broke converting. If you're 70 or 80 years old, I get this question: am I too old to convert? Well, it should never impact your current lifestyle. You shouldn't be converting and then keeping yourself paying all this tax. I'll say it, I'm trying to say it in a nicer way, but
Hmm.
given the cost versus the benefit in your limited life expectancy is just not worth it, especially if it impacts your lifestyle. Nobody should go broke converting. You should be thinking about yourself first. However, if you could be 80 years old and say, look, I don't even need that money. I'm converting for my children and grandchildren. Well, that's another whole story. Then you might want to convert and maybe take advantage of the tax brackets because it doesn't impact your financial security. That's rule one. You have to take care of yourself first. It cannot impact your financial security during lifetime. People worry too much about the kids. And I even said this would be a great gift to the kids, but not if it impacts your lifestyle.
Got it. All right. Uh, Right. Totally makes sense there as well. So let me ask you this. You
You want to
said,
hear a nice little strategy I've used for people? It doesn't apply to everybody because we
sure,
started talking about older people. Let's say you're watching this now and you have followers or viewers that may be in their 50s, and they may be that person that's doing well in a high bracket.
I got
And
plenty of those watching right now.
right, all right. So, but their mom's around and their mom has an IRA, but she's in a low bracket, taking her RMDs and all that. Here's an idea. Give your mom money to convert her IRA to a Roth IRA because she'll do it at her bracket. She has to still take her RMDs. RMDs can't be converted. But after her RMDs are taken, make her a gift, and the gift limits are very high. I mean, you can gift up to $15 million a year, 30 million per couple under the new rules. So and you could do 19,000 a year just in the annual gift tax exclusion. Doesn't even account against the 15 million. So that's not even an issue. There's no gift tax or anything. So you could gift mom money to convert her to a $300,000 IRA, convert it all. She'll still probably be in a low bracket. The only trick here is make sure she names you as the beneficiary,
Right. Yep.
because then you're going to inherit her Roth at some point, but it was paid for at her rates.
Correct. And then you've got 10 years to basically do whatever you want with that money.
Right.
Right. But hopefully mom lives a long time. So you're not seeing
Yeah.
that long into the future when hopefully maybe it's actually appreciated a fair amount. And I'm curious if she converts at all, like you said in that example, she doesn't have any more RMDs, does she?
Right, right. Then she has a Roth, and not only that, her income is lower because of no RMDs for the rest
Yep.
of her life. It may even lower her IRMA charges, her Social Security taxation, and everything based on income.
Man, that makes total sense. That's a
It's
great
just, you
idea.
know what I call it? I call it estate planning up the family tree, reverse estate planning. Everybody that does estate planning looks how to get money down to the children and grandchildren, but nobody thinks about the parents. And this could be one situation where it pays to gift up the family tree.
Yeah, absolutely. I mean, that just makes total sense to me. So you're giving us lots of great jewels here, Ed. Thank you. So, question for this. I asked you, and you said yes. You can, if I've got a big tax deferred account, I can convert all of that in any given year if I want to. Um, can I do that every year? Like, can I put money into a regular IRA, make a contribution for the year, and then at the end of the year convert that over and just do that year after year, or there's
Yeah,
some
what you're
limitations on that?
describing is basically the backdoor Roth. You would only do it that way if you're making too much money to contribute to a Roth IRA. But if
Hmm.
you have a very large IRA, you can bite off bits. Then you don't have to do the backdoor Roth. Then you can just do, I'm going to do 200,000 a year or something. I was just speaking to somebody who's doing exactly that, doing say 200,000 a year to knock down a $2 million account, too much money in their IRA.
Right. So that's taking your bites of an existing RIA.
Yeah,
I'm saying, let's say I've already done that. So I'm this successful 50-year-old. I decide to
yeah,
take all the pain today and I convert everything I have. Next year, can I make an additional contribution to that tax deferred IRA and then roll that
yes.
over again too?
Right. But if you're going to roll it over, why not just make a contribution to the Roth IRA unless you're over the income limits?
But I'm assuming in this case you're over the income.
Yeah. All right. That's called the backdoor Roth. You make a non-deductible IRA contribution to a traditional IRA and then convert it to a Roth.
Okay. And I can do that year after year after year.
Yep.
There's no
Yep.
limitations on it.
Yeah. People
Wow.
do
It
it
seems
every
like
year.
almost cheating the system to a certain extent, but I guess the government's getting paid today every
Yeah,
time
the
you.
government, you bring up an excellent point. One of the biggest objections to doing Roth convert, I don't know if it's objections, but things I get from consumers at programs, hear me talk all about the Roth, and they said, but Ed, somebody always asks this, can I trust the government to keep their word that Roth IRAs will always be income tax free? And my answer is always no. You can't trust them as far as you can throw them. We have a saying among CPAs, tax laws are written in pencil. But I have no problem with that. I don't see that as a problem. Why? Because luckily, as I said before, Congress is short-sighted. They're the worst financial planners on earth. They actually love the Roth because it brings in money up front for their budget
Hmm.
cycles. So anything, that's their golden goose. If you look at the last few tax bills, that's what the Roth provisions were in the revenue provisions to pay for everything else in the bill. And if you look at it, I don't know if you go how far back you go, but if you remember in 2000, before 2010, you couldn't convert to a Roth IRA if your income exceeded $100,000. I don't remember if you know if you I don't know if you remember those days.
Hmm.
When Roth first came out, you couldn't contribute if your income exceeded 100,000. Congress, as usual, needed money, and somebody say, why don't we get money from people who make more than 100,000? So they eliminated that restriction, and they got a boatload of money, including people like me. That year, I converted everything. The minute they eliminated that restriction, I converted everything in 2010. You want to take a guess on how much tax I paid in 2010?
I'm going to say zero.
Zero is the answer. That was the deal of the century. If you went to my seminars, I begged people to take that deal. The point is, Congress was desperate for the money, but if I paid zero, how'd they get the money? The deal was, we're going to let everybody, regardless of income, no more income limitation, convert, because they wanted boatloads of money to come in, and they got it from people like me. But the deal was, if you convert in 2010 as an incentive, no tax in 2010. You could pay half in 11, half in 12. In other words, the government gave everyone an interest-free loan to build a tax-free savings account. It was the deal of the century. I begged people to take that deal. And even professionals in my audiences and consumers didn't take that deal. Why? They didn't even want to pay the tax under those circumstances. Even then, the short-sightedness took over. And if you look at it, back in 2010, I believe the market, the Dow, was about 11,000. Even now, it's 4 times that. All of that growth for the people who did that is all growing, has all been growing for now 16 years, income tax free and compounding income tax free. So looking in hindsight, you might say, it would have paid to pay the tax, but people are not looking, they're again short-sighted. Nobody wants to pay a tax. So the reason I bring up that deal is because once Congress saw the money they got in from that deal, they said, let's expand Roth 401ks, let's expand Roth 403bs, and then eventually they added SEP Roth IRAs, simple Roth IRAs, 529s to Roth. They wanted everybody to do Roths. They want, in fact, this year, 2026, is the first year Congress actually mandated Roth contributions for catch-up contributions. People that work at a company that get catch-up contributions, they're over 50 or over the 60, 61,
Yep.
62, these are the catch-up contributions. If you made more than 150,000 last year on a W-2 at this company, your catch-up contribution must, by law, go to the Roth. Not the worst thing in the world, but people would like a choice. But
Right.
this is where I'm saying Congress is tipping their hand. They love the Roth because they get their money up front. So I don't think that's a risk of Congress killing their golden goose.
Okay, so what I'm taking from you, Ed, is you're saying, look, we all hate paying taxes, but obviously it makes sense to pay taxes now if it's going to save you more taxes down the road. And we're in this beneficial moment in time where tax rates are historically low and the government is actually leaning into Roth-based solutions.
That's
So,
right.
so
That's
basically,
right.
don't be an idiot, take advantage of it.
Well, everybody's situation is different. If they truly believe they'll be in a lower bracket, you go back to my rule, always pay taxes at the lowest rates. If those will be your lowest rates, then the Roth is not a thing for you.
Okay. All right. Well, look, this has been great, Ed. I want to ask you about annuities, which is something you
Yeah.
also spoke at. But real quick before I do, um, Roths are great vehicles for saving lifetime taxes. Are there any other strategies that are worth talking about here before we move on to your annuity concept?
Well, the annuity I don't sell, just so people know. I'm a tax accountant, a tax advisor. I don't sell stocks, bonds, funds, insurance, annuities, none of that. I don't do any investment. I don't make any money over any. We're an education company, essentially, is what we do. But there is a case to be made to have guaranteed income with these gyrations in the market. And it might not be a bad idea to take some of those gains off the table, some of those chips off the table in that casino we were talking about,
Hmm.
where everything is generally up, except the last few weeks, but generally up. Maybe take some of those chips off the table, cash them in at today's low rates, and get yourself and speak to your own advisor if it's right for you. A guaranteed annuity, guaranteed income through an annuity where those checks come in. I mean, they're guaranteed. As my own rule is for your basic monthly living expenses. Those shouldn't be left to volatility in the market. Oh, I can't pay the light bill because the market's down. Nobody should live like that. So what I mentioned, you might have heard me talk about that at that conference, because my mother, obviously before she passed, she had these annuities. I didn't even know what they were, but my father died much earlier. My mother lived into her 90s, and she had an advisor that realized she was like the Energizer Bunny. She's going to be going a while. And he put her in these 4 or 5 annuities. Turned out to be the best thing that ever happened to our family. Those checks came in every month, no matter how old she got, no matter how sick she got, and no matter how the market performed. She never worried about money. And I don't have any data on this, but from what I see, people like my mother and others, people with guaranteed income, they're just happier people. They don't worry about anything. Even at the end, before my mother passed, I was up at the hospital with her, and I said, "Ma, you only have $600 in your checking account." She says, "What do I care? I get 5 new checks every month." That mentality that you'll never run out of money. There's something to be said for that. But one thing I did mention that I picked up from my mother, I got annuities myself just as a hedge, to have some guaranteed income. But the only thing better than guaranteed income for life is what I have, guaranteed tax-free income for life. How did I do that? Well, I followed my mother's lead, but I got the annuities in my Roth IRA. What does that do? Well, I'm hoping never to need the income for life. I hope it goes to my kids, but let's say I wanted to tap into that. It would be guaranteed for life, and because it's coming out of a Roth, it's guaranteed tax-free. And it's not for my whole Roth, a very small portion, but enough to protect against any downside risk as a buffer, a guardrail, whatever you want to call it. It allows me to be much more aggressive with the lion's share of my Roth investments.
Right, because you know every
Right.
month when those annuities kick in, you're
Yeah.
going to get that check. Hey, real quick, to me, this makes a ton of sense, right? I love it. It's your guaranteed income, but it's tax free as well, which is great because you
Because
could
I
have it.
love anything tax free. You know me.
Yeah, well, and it's like, why wouldn't you do it in your Roth, right? So I could get
Yeah.
an annuity, it would pay me, but then I'd owe taxes on that, so I'm getting only a percentage of the check at the end of the day. Well, if I just have my Roth buy it, I get the whole thing. Like,
Yeah.
just why wouldn't I do that?
Right.
Yeah. And you said one thing I just want to clarify though is you said the annuity is guaranteed for life. So the
Well,
annuity part
depend
of
on,
your
they're all different products. Again, I'm not a product guy. It's like every different flavor and bells and whistles and features. You can turn some features on or off. So
off.
you have
Okay.
to speak to a professional or do your own research. Every one of these products has different bells and whistles options to choose from.
Okay. Let me just get the thought out. But if it were one that was for the life of the annuitant,
Yeah.
that is something that would not pass on to your heirs as part of the IRA
If
after
that's
you're up.
your, I don't have that kind because I have a death benefit on mine. But you pay for that internally, so you would get a lower lifetime benefit. It's all the actuarial numbers. So yeah, if you wanted it to end in your life, you'll get a much bigger monthly check. I didn't choose that.
Okay. All right. So obviously be careful about what you're agreeing to and the impact it might have on things, but also the benefit is there's so many different options there. You can pretty much custom create what you want.
Right, right.
Yeah. All right. Well, Ed, look, this has been super useful, very informative. And I'm going to say this, and you can clarify anything you want on top of this. But folks, if this is sounding of interest to you, I highly recommend, especially if this is something you're not already doing yet, sit down with a good financial advisor
Right.
and or your CPA and go through the different options that you think you might want to do. And of course, they might be able to come up with a whole bunch of options that you haven't even thought of yourself. But really do have a professional run the numbers for you, give you lots of different options, and help you triangulate in on what's going to be best for you. But obviously, Ed, you've given us a lot of fodder for thought here in terms of ways to basically reduce taxes we'll pay over the rest of our lives,
Right.
and thus increase the amount left over that we have to actually live our lives and enjoy our golden years and pass stuff on to our family.
Yeah, and be with the Roth, I have to add this. You have to be careful. Roth conversions are permanent. There's no backsies, no do-overs, no
Hmm.
recharacterizations that we had years ago. So I would have these conversations or do your research, but I would not pull the trigger on a Roth conversion until the first week of December, when the capital gain distributions come in, when you have a better idea of wages for the year, income, expenses, so you can have a better projection of what it's going to cost you on what bracket you'll end up in.
Okay. And do you know with doing the conversion, can you do it in that window between January 1st and tax season?
No, no, no. That's the challenge with Roth. It's not like an IRA. You have until April 15th to put money in an IRA, a contribution to an IRA or Roth for last year. There is no last year concept for Roths. So it's a challenge. If you want a Roth IRA conversion for 2026, the funds have to leave the IRA in 2026 when you won't know the exact bracket. You have an idea, but not exactly until
Hmm.
you see that tax return. You say, where do all these capital gain distributions come from?
Okay. All right. Well, look, Ed, thank you for coming on and sharing all this with us. For folks that would like to follow you and your work, where should they go?
IRAhelp.com. It's an amazing site. I know it's our site, but there's so much free and quality information. www.IRAHELP, IRAhelp.com. We put out blogs several times a week. We answer questions. And when I say we, I'm talking about experts. You'll see the question. You could learn so much just from going into the mailbag where people write in questions. We even
Hmm.
say, bring your questions. But oh, and we also have a part where other people can answer your questions, and usually experts log in there. So you might say, well, if anybody can answer, that's a different section. The section we answer, you're getting it right from the experts. But I forget what we call it, the mail. It's not the mailbag, something where it's like a bulletin board where you could just ask a question and anybody. It's an open forum.
Let the community hive
Discussion
mind
forum,
answer.
that's what it's
Yeah.
called, discussion forum, I think. So anybody can answer. So you might say, well, if I put something in there, how do I know the answer is going to be correct? I'll tell you, it's self-correcting because we have had such a following on there for over 20 years. If you post an answer on there that's wrong, you will hear from about 20 people within about a minute. And they'll say it's wrong because you forgot these three things. And when that happens, you learn so much from that.
Excellent. All right. Well, look, Ed, when I edit this, I will put up the link to your website there so
Yeah.
folks know exactly where to go. Folks, the links will be in the description below this video as well. All right. Well, as we wrap up here, folks, please extend your gratitude for Ed for being so generous with his expertise here with us today by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And very important, as we mentioned, if you're planning on acting on this, I highly recommend that you do so under the guidance of a good financial advisor and your CPA. But if you don't have a good advisor or CPA advising you, feel free to talk to one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To set up one of those free discussions, just fill out the very short form at thoughtfulmoney.com. Tell them you saw this video with Ed and you want to talk to them about the strategies that we mentioned here. They'll be happy to sit down with you. And again, these consultations are totally free. There's no commitments involved. It's just a service they offer to be as helpful to as many people as possible. Also a reminder that we had the Thoughtful Money Spring Online Conference this past weekend. It was absolutely fantastic, folks. Hands down the best one we've ever done. And couldn't have been more timely with everything going on in the world, particularly with the war there in Iran and all the knock-on effects that's having on the markets and the global economy. If you did not attend that conference and wish you had, don't worry, you can purchase the replay to the whole thing. To do that, just fill out the very short form, not even the very short form, just go to thoughtfulmoney.com/conference and you can quickly buy the replay video of the whole event, all the presentations, all the live Q&A there. All right, Ed, I can't thank you enough. This was so informative. Really look forward to having you back on the channel again soon.
Yeah. Thanks, Adam. Great show. Thank you.
Thank you, and look forward to having you back on again at some point in
All
the
right.
future.
Yeah.
All right, and everybody else, thanks so much for watching.
First of all, there's no certainty that the Fed will choose a figure of 15,000. They might just choose, if they do it at all, the spot price. And in fact, there's a small indication that that might be under consideration because of the publication by the Federal Reserve on the 1st of August about gold revaluation and how other countries have accounted for it. And in that particular paper, they discussed revaluing gold to 3,300, which was the price on the day they did it. So first of all, 15,000 is not written in stone, but the real point is the higher they revalue gold to, the higher the level they value it at, the more profit they can make, the more money which can be printed without increasing the level of government debt, because when they revalue gold, effectively the net result is the Federal Reserve will end up with this thing called gold certificates.
With public debt at high levels, some governments have begun to explore financing additional expenditures without raising taxes, while also not increasing public debt outstanding. Colin Weiss wrote in Official Reserve Revaluations, The International Experience on August 1st. One possibility is using proceeds from valuation gains on gold reserves, as has been floated in the US and Belgium recently. For the US, this would involve revaluing the government's 261.5 million troy ounces in gold reserves, the largest gold reserves globally, from a statutory price of $42.22 per troy ounce to current market prices, which stand around $3,300 per troy ounce. Noting this scenario, the speaker, Clive Thompson, highlights that the Fed isn't guaranteed to pick a revaluation target of $15,000 per ounce. They might even use the spot price instead. The Federal Reserve published a research note titled Official Reserve Revaluations, The International Experience. The paper examines 5 countries, Germany, Italy, Lebanon, Curacao, Sint Maarten, and South Africa, that have revalued gold or foreign reserves to bolster their finances. The Fed has not committed to a specific revaluation figure, such as $15,000, using market prices, is still on the table. The study examines how other central banks have utilized revaluation proceeds to offset operational losses or provide government financing. However, the US has yet to take such a step. If revaluation occurs, then this paper profit could be converted into gold certificates and handed over to the Fed. The Fed could then credit the Treasury with new dollars, allowing the government to spend without officially increasing its debt. This is why some refer to it as a hidden financing tool for the state. Central banks have different methods for valuing their existing bullion holdings. Some value their gold reserves at their historic cost, others report it at current market prices, he said. When central banks report their holdings at current market prices, fair value, the unrealized profits or losses from valuation changes are recorded. When gold is valued at historic cost or modified historic cost, gold reserves can be revalued at market prices or values closer to market prices to generate revenues, he noted. When all official reserves are valued at market prices, the unrealized valuation changes recorded in the revaluation account can be shifted to other. Now, we present the clips from the interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you and enjoy the video.
First of all, there's no certainty that the Fed will choose a figure of 15,000. They might just choose, if they do it at all, the spot price. And in fact, there's a small indication that that might be under consideration because of the publication by the Federal Reserve on the 1st of August about gold revaluation and how other countries have accounted for it. And in that particular paper, they discussed revaluing gold to 3,300, which was the price on the day they did it. So first of all, 15,000 is not written in stone, but the real point is the higher they revalue gold to, the higher the level they value it at, the more profit they can make, the more money which can be printed without increasing the level of government debt, because when they revalue gold, effectively the net result is the Federal Reserve will end up with this thing called gold certificates, which is not part of the USA debt, doesn't have any interest, and has no maturity date. So what they're basically doing, if they do a revaluation at any level, they are swapping the debt that they have at the moment, or some of it, for gold certificates, which is not debt according to the official the Treasury balance sheet. Now, as I said, the higher the price they do it, the better it is. So I picked a figure out of the air of 15,000. I kind of felt my figure was on the low level compared with some other people who've been picking 20,000. But of course, the level at which they'll do it, if they do it at all, would be at what level do they dare to do it without disrupting the market? Because we don't want to, well, they don't want to do a figure which is going to make people panic and say, oh my God, the dollar's worthless because they've done this. So I kind of chose that number based on what I thought would be a right number relative to the amount of money they've been printing in the past. As you know, they're printing roughly $2 trillion a year effectively in new debt to pay for the budget deficit. So the figure I picked of $15,000 would cause a new printing of 3.9 trillion as opposed to the 2 trillion a year which is being created. So that would be very, very slightly inflationary, not much. I mean, let's face it, with the amount of money which has been coming into existence over the years, it's not a big deal. For example, it's only about 10% of the national debt. Well, I think if you're buying physical gold and silver in the form of coins and bars, the thought process ought to be one of, I'll keep it forever unless there's no choice. So it's kind of like an heirloom. It's a bit like if you buy a painting, you put it on your wall and you expect to pass it down the generations. Obviously, it's an asset which can fly a little bit under the radar screen, which can be advantageous depending on how you look at it as well. So when I buy physical metals, I tend to think that I'm not buying them with a plan to sell tomorrow or next week or next year or 5 years or 10 years or at any price. It's kind of like the parachute you've got just in case the worst comes to the worst and you've got no choice. But if you want to trade in and out of gold and silver, then the way to do it is the way, I know you don't like it, Mario, but the way to do it is through ETFs or gold mining shares or things on the stock market where you can trade with a very narrow spread and at high speed. But that's a completely different kettle of fish from having a parachute. Trading is where you buy something with a plan to sell it quickly and make a profit. Whereas I think the reason why a lot of people are choosing to buy gold these days is because they fear that the financial system that we are in is getting close to the end. I fear the trust in fiat money could evaporate very quickly, and then they might be forced into a new system. And if you own a gold coin before we cross that line, you'll still own it afterwards. Whereas if you've got something in custody, subject to the whims of a third party, you're not sure where you're going to stand. You're not sure if they're going to take it from you.
Francis Hunt, also known as Market Sniper, points out that a significant revaluation of America's gold reserves could instantly boost the federal balance sheet by recognizing hundreds of billions in previously hidden assets, thereby improving the debt-to-asset ratio and bolstering confidence in U.S. bonds and the dollar. By providing extra backing for government obligations, it could help address record-high sovereign debt while reinforcing gold's role as an inflation hedge, signaling limits to currency debasement and strengthening trust in U.S. monetary stability. Despite its potential benefits, gold revaluation would likely trigger significant market disruptions. Financial markets have operated for decades under the assumption of fiat currency dominance, and an essential shift in monetary policy could lead to substantial volatility across asset classes. Revaluation might paradoxically create inflationary pressures if implemented too quickly or without careful communication. The sudden recognition of additional national wealth could alter inflation expectations and lead to accelerated price increases in the short term. Major gold holders, such as China and Russia, who have both been actively increasing their reserves, would likely react with deliberate actions to capitalize on a more gold-driven monetary environment if the U.S. were to revalue gold. A comprehensive legal and regulatory foundation would be required for such a change, including congressional consent, coordinated action by the Federal Reserve and Treasury, and a clear implementation strategy. The foundation for this strategy may already be in place, according to recent Treasury remarks on asset monetization. Growing awareness among financial professionals and officials highlights gold's potential as a significant instrument for addressing America's debt issues, although the timing and scope of any adjustment remain unknown.
What does history show us on revaluation conduct? It shows us that government has no interest in making its citizens wealthy. What did they do previously? Roosevelt got everyone out of the metals by decree, by threat of law, massive fines that would run into millions today. It was tens of thousands back then when you bought houses for that kind of money, and multiple years in jail. What did the events of COVID tell you about their approach? They're in it to enrich themselves. You weren't given the heads up of something coming, then everyone's speculating and all jumping into pharma shares. They took the money and they closed your businesses down. What do the possibilities of the great taking tell you? The possibilities of the legalese versus the English show. When you understand where they're seeking to take us, and this is my conspiratorial nature, Clive might think, but we are looking at a global communism and totalitarianism to make everybody reliant on UBI, as large a segment of the population as possible, so that you ultimately control them. If you control the food supply and you control how they earn and what they can eat, you have the end goal that I believe these people have always sought. So the lottery hope of a 4x, 5x, 6x on gold that will benefit quite a reasonable sway. Now, as we say, hedge funds don't really have a lot of gold, but there is still in the liberty movement quite a high tendency to stack gold and silver, that their greatest enemies, and believe you me, libertarian people who seek self-reliance are invariably the biggest enemies of a totalitarian state who's seeking a great leveling in the Western markets. You are not likely to get this lottery ticket. And I don't want to be the guy behind hopium on this for a number of reasons. However, truth does out, and I think the option of a mark-to-market is far more likely, and the force of necessity and the inflation that they're going to be generating could see Nixon-esque regular mark-to-markets to open up the overdraft out of force of necessity, which probably means they'll go either for a similar confiscation or other aspect, which is a bit draconian, but depends how totalitarian we get. We're being told a lot what to do, but they can also do their unrealized capital gains, which is what probably my primary scenario, where they can enforce sales by instituting an unrealized capital gain on you. So they want to know what you have, so you're going to have to blockchain it. I would suggest maybe having some gray or black gold, which would be off-grid, illegal, and probably punishable by death, given that they're the Marxists that they are. And you probably will face capital gains tax even if you have not sold, just by virtue as they know we're patient stackers. That's how they have a plan for gold and silver, guys. Without a doubt, and they aren't going to enrich us without a clawback or an attack vector. And it's not good news for me to say that. Don't shoot the messenger. I'm just very clear about what history tells us about the kind of people we're dealing with. They do the revals after they've stripped you out. And if they're not going to be able to get away with doing that now, they're going to make sure they get their pound of flesh out of you, the Shylocks that they are. So that's my take for the question. We've got to watch for those attack vectors if they do end up giving you a decreed new price that isn't price discovery. There's a lot of legalese that will have to be negotiated. I don't believe they'll be prepared to bankrupt the banks, their shareholders. And I don't think it's a high probability, and don't get sold on hope, because then you don't get the crash of the disappointment. Mark to market is far more feasible. And I think it could regularly be mark to market, because once they do it once, it becomes the tap that they keep dribbling the drops out of and getting sustenance. So it could be repeat. And I think you should keep doubling down and keep giving them back their fiat and keep stacking. And you should have locality, optionality, so that you don't get taxed out of your metals. And that's what we do for our community very specifically, because it's not just what you make, it's what you get to keep.
A revaluation of U.S. gold might reveal enormous latent value in the country's reserves, enhancing fiscal stability, fortifying the dollar, and indicating a cap on unrestrained currency production. To prevent market turbulence or inflation shocks, such a move would necessitate rigorous coordination between the Federal Reserve and Treasury, a precise legal foundation, and a well-managed communication strategy. The ramifications would be seen globally, changing monetary policy and potentially hastening the transition to a financial system that is more heavily reliant on gold, with big gold-holding countries like China and Russia ready to react strategically. What short-term effects may a gold revaluation have on international financial markets? What legal and practical measures would the United States need to take to carry out such a revaluation? Please leave a comment below with your comments on Clive and Francis's gold revaluation analysis. If you find this video helpful, please give us a like and turn on notifications to stay up to date with our latest videos. I'll see you in the following video. Thank you for viewing.
I think everything's on the table. We just have to be patient. We have to be appreciative of these prices below $40. I think once it takes out $50, it can happen rather quickly that we rally towards $75 and then maybe $100. And technically speaking, we have the mother of all cup and handle patterns in the silver market. It's a 50-year pattern there in the making. And on a linear chart, we're talking $100 price target. On a logarithmic chart, we're talking $500, $600, $700 price targets for silver. And if we look at the gold-silver ratio, you can also definitely make the case for three-digit silver. These are the round psychological numbers. Obviously, we are in uncharted territory above 3,500. And then I think down the road, yeah, I'm more or less in the camp of 10,000 gold at some point over the next few years.
Silver supply is limited since little new production is coming online, and most is just a mining byproduct. The speaker believes silver is setting up for a massive move, supported by a 50-year cup and handle pattern. Once silver breaks $50, it could quickly surge towards $75 and even $100, with long-term targets as high as $500 to $700 on a logarithmic chart. The gold-to-silver ratio also points to the potential for three-digit silver prices. On gold, the outlook is similarly bullish, with projections of $4,000 to $5,000 in the near term and the possibility of $10,000 in the coming years, with a shallow pullback to $3,120 presenting a buying opportunity. Demand remains strong in Asia, led by China and India, where cultural and safe haven buying continues to support prices. Hong Kong gold imports surged 127% in July, while China's overall consumption dipped 3.5%, though bar and coin demand jumped 24%. Chinese investors also drove record ETF inflows of 70 tons in 1 month, doubling their share of global ETF assets to 6%. In India, jewelers stocked up ahead of festivals despite high prices, paying premiums up to $4 per oz. Overall, Asian physical demand was robust, with Chinese bar and coin purchases up 44% and Indian demand up 7%. Florian mentions that gold is holding steady amid a softening US dollar and yields. Overbought conditions signal a need for fresh catalysts to break past $3,400, though the metal remains well supported. Major institutions such as Goldman Sachs and JP Morgan forecast gold prices reaching $4,000 by mid-2026, supported by structural rallies and dollar weakness. Pullbacks remain possible if gold becomes overbought or risk sentiment improves. Before we begin, please subscribe and enable the notification bell so you stay up to date.
I mean, here we are, end of August. Everything's a little bit slower. That's totally normal. People should actually spend this time in the summer with the families at the beach or at a beautiful place, taking off and like recharging, right? So nothing to worry here. Of course, last week, the big Jackson Hole event kind of like created some volatility in the markets, but I would not overvalue all these statements. I mean, in the end of the day, it's the price action. The market usually is dictating what the Fed is in the end of the day doing. So we have seen gold consolidating now since end of April, more than 4 months, healthy consolidation on high levels. I think you and I agree that we probably both have expected maybe a bit more of a deeper correction back in end of April when it rushed to that new all-time high at 3,500. But all the market gave us was a low at 3,120. And already that looks like a buying opportunity in hindsight because gold is trading nearly 10% higher. So it's holding up really well. I think it's strongly supported by the physical demand out of China and Asia, of course. But I think also slowly but surely the Western big money, so to speak, is waking up to the fact that gold is the last man standing. And it's a clear bull market in comparison to all the other markets. You have a very strong, clear bull market in gold. And I assume that it's just a question of time until we see the next leg up. Gold is trading in a tight trading range. It's getting tighter and tighter. Over the last few weeks, it's been less than $100. We had some days recently with less than $10, $15 of a trading range. And it doesn't take much for gold to break out. I mean, already 3,400 is already the next probably buying signal here, a pro-cyclical buying signal, if it breaks above that, and it just takes another $5 from you as we speak. So it looks very bullish. It's been holding up very well. It's, I think, the most interesting and exciting market. It reflects not only the things that we just talked about, historically speaking, and when it comes to value investing, etc. But of course, it's also a geopolitical, in-depth kind of story that you can read if you look at the gold price and its development. So I think it's all looking very, very positive and promising for gold here. Usually these consolidation periods end with one little bear trap. You get one little quick nasty sell-off that shakes off all the weak hands, and then the market turns around violently and rallies hard to the upside. Maybe that's still around the corner in September, but I don't see any big downside here. I think I wrote this in Gold We Trust report in May already. I said gold is most likely not coming below $3,000 anymore, and here we are. And it's holding up very well. The only situation where I could see a little bit more of a challenging times ahead is really if the stock market would get into a deeper correction, something maybe that like we've seen in January until March with a big final panic kind of in the last days of March, early April. But whenever this liquidity suddenly disappears, and then of course gold and silver prices are also affected in the short term, but whenever this disappears, the liquidity, magically a few days later it reappears and shows up again, and then it's a buying spree within a 2-week kind of everything changes, and 2 months later you have new all-time highs in the stock market. And of course gold and silver is also strongly moving higher. So remember that sell-off that quickly led to silver falling below $30 actually was the launching pad for that 40% rally since then in silver. So it's always this mass psychological phenomenon. It's sometimes hard to time, but usually you can see in the charts more or less what's around the corner. And here we are. It looks like gold is about to break out and move higher, and it doesn't take much to the all-time high. And after that, I think we're moving to $4,000 rather quickly.
Florian points out that we are clearly in a precious metals bull market, but it hasn't reached the euphoric stage yet. Other assets like Bitcoin, tech stocks, and real estate have captured attention, while inflation and economic strain have limited many investors' capacity. Still, with ongoing money printing and global instability, gold and silver are likely headed much higher. Typically, bull markets end with explosive moves where prices double in a short time, and we haven't seen that yet. Looking ahead, continued fiat currency debasement could drive gold toward $4,000, $5,000. Rising volatility is expected, with daily price swings of several $100s possible, similar to past hyperinflationary episodes. The main concern, however, is the push for central bank digital currencies and tighter financial surveillance, which could make it harder to trade precious metals openly and potentially push transactions into black markets. Let's recall the interview now.
Well, I think we are in the bull market, right? So the surprise is clearly to the upside. Usually those bull markets end in total euphoria. I don't think we are there yet at all. I mean, you don't have your taxi driver and your grandma telling you all the day to buy gold and silver.
Your grandfather did,
So
though.
I think, yeah, but my grandfather, mom has not called me telling me
All right,
to
right
buy
on.
gold and silver. He just bought. I mean, it's another one for like usually the joy come kind of late guys. I don't see them moving into gold like euphorically right now. I think there's so much going on in the world of investments and so many other topics. Of course, Bitcoin has taken away a lot from the gold cake over the last 10, 15 years, and the tech stocks. And also, I think many people just don't have as much money anymore because inflation and all these difficulties during the COVID period. It's a complex kind of setup that we have here, but we are in a bull market in precious metals. I think the best is yet to come. Usually at the end of such a bull market, you see that asset doubling within a few days or weeks. That's usually the signal where, oh, now it's really the top. We want to be careful and probably move into something else, but we haven't seen anything like that. I think that the Western world is in such a dire shape that money printing will prevail and even intensify over the 12 to 24 months. And that will push every asset overall higher. So I've been calling this the cracker boom for many years already. And I also described it before a little bit, like you have, in the end of the day, the depreciation of your fiat money is making sure that most of the good assets, or more or less good assets, are rising over time. So your real estate is becoming more dollar in euro. Your stocks, the good stocks at least, or the better ones, or the ones that are being chased through the village right now, are moving higher. And of course, precious metals and Bitcoin as well move higher overall. I think we're going to see a lot of volatility. I think that, and that's, by the way, if you the Weimar Republic hyperinflation, you can see how dramatically the volatility increased in the years between 1921 and 1923. So something like this is very likely, and we probably will then also see $300, $400, $500 swings in the gold price on a daily basis. But we're not there yet. That's why we should appreciate these rather quiet times right now. I think gold is probably on the way to 4,000 and then 5,000. I mean, these are the round psychological numbers. Obviously, we are in uncharted territory above 3,500. And then I think down the road, yeah, I'm more or less in the camp of 10,000 gold at some point over the next few years, simply because I assume that the money printing, the fiat money printing will continue. And in the digital central bank kind of money that they try to push on us, that's my main worry, actually. And it's very hard what to make out of it, to be honest, because it can theoretically mean that at some point we're not able to buy and sell our precious metals within these currencies anymore, and we have to maybe go back to black market kind of situation. Who knows?
Florian emphasizes that gold and silver are firmly in a long-term bull market, supported by strong Asian demand, central bank buying, and technical setups pointing to much higher prices. While both metals may face short-term volatility, their role as safe haven assets amid fiat debasement, economic strain, and geopolitical uncertainty suggests far greater upside ahead. With projections of $4,000 to $5,000 gold and silver breaking toward triple digits, the next explosive phase of the bull cycle may be closer than many expect. Could central bank digital currencies limit access to physical gold and silver, reshaping how investors participate in the bull market? What technical or fundamental signals would confirm that gold and silver have entered their euphoric, final stage of the cycle? We would love to hear your thoughts, so please share them in the comments box below. If you found this video helpful, please give it a thumbs up, and remember to subscribe for future videos. Thank you for joining us on this adventure.
I think China is going to shock the world, and the Chinese bond market is going to grow, and it's going to become the biggest as well. De-dollarization and the growth of the yuan, overseas yuan bond market, and that has been one of the linchpins, an overseas bond market for demand for the dollar. In London and in Europe, we've had what's called the Eurobond market, where dollars abroad are issued or lent to corporations. Australia's Fortescue said on Friday it had secured a yuan-denominated loan worth 14.2 billion Chinese yuan, $1.98 billion, to ramp up its decarbonization plans. I know I have an opinion about that, but I'm just trying to look at de-dollarization and the rise of the yuan.
China is positioning itself to shock the world by rapidly expanding its bond market, which could eventually rival or surpass the U.S. market, reinforcing the broader trend of de-dollarization. UBS estimates China's domestic bond market at around $25 trillion US, ranking among the world's largest. Beijing is also drafting new rules to strengthen cross-border yuan financing, making it easier for banks to support offshore yuan lending and bond issuance. Meanwhile, China is cutting its U.S. Treasury holdings, diversifying into agency bonds, gold, and other non-dollar assets amid rising geopolitical tensions. Now, yuan-denominated debt is taking on that role, as shown by Australia's Fortescue securing a 14.2 billion yuan loan to fund decarbonization projects. This shift highlights how the yuan is steadily gaining ground as an international financing tool, reducing reliance on the dollar. Mario Ineco, a former City of London bond trader turned independent financial analyst and commentator, points out that non-G7 nations have been working to reduce their reliance on the US dollar, not to replace it entirely but to gain more self-reliance, especially after years of US sanctions and political pressures. Much like finding a new bank when the old one becomes restrictive, these countries are building systems to trade and finance among themselves without always going through the dollar. While experts once argued it would take decades for China to become a major player due to its underdeveloped bond market, that is changing quickly. Overseas firms are increasingly issuing panda bonds, yuan debt in China, to access lower-cost financing and hedge geopolitical risk. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Countries, we're trying to basically become less dependent on the dollar system, not because they want to destroy the dollar, but because they want to be more self-reliant. They don't want to depend on the dollar alone. And one of the reasons for that, of course, has been the regime of sanctions and other political punishments by the U.S. in the last 15 years. And it's akin to you having a bank account with a particular bank, and this bank starts making it hard for you to deal with them. Well, you're going to look for another bank. And I think the Global South, or the BRICS, if you want to call it really, they're not really looking for another bank. They're not really looking for another reserve currency. They're looking for another system that they can deal amongst themselves, that they don't have to go through the US dollar, a third-party currency. And yes, back in 2017-18, when I started talking about this, it wasn't even on the radar screen, but now it's becoming more and more important. And what I want to talk about today is something about the bond market, which is a market that, of course, I worked in for over 20 years. It wasn't the corporate bond market, but it was the government bond market. But it's a very important market. The bond markets are the biggest markets out there. They're bigger than the stock market or the equity market. And I remember Jim Rickards actually talking about reserve currencies and whether the yuan or the Chinese renminbi would become a major reserve currency. I don't remember exactly how many years ago, maybe at least 5, maybe 7, 10 years ago, he said, yeah, China is never, not never, but he said it would take decades for them to really be a major, have a major part in the world's monetary architecture, trade architecture, because they don't have a bond market like in the U.S., a deep bond market, but that's also changing very quickly. China seems to do everything very quickly and very well, and I'm not like defending China or its political system. I'm just looking at the facts, and that's what a lot of people have a problem doing. They get too bogged down in the politics and things like that, instead of looking at the numbers and the facts, of course. So I'm seeing a lot of stuff about China. For example, Vince Lancy posted this yesterday. Yuan bond growth. Countries are beginning to issue debt in yuan. Hungary's 5 billion yuan panda bond in July was the largest sovereign deal of its kind, while Russian energy firms are preparing yuan-denominated paper. So 5 billion yuan is under $1 billion. That's pretty small. But we're also seeing that other countries, and I think I spoke about this a couple of weeks ago or so, like developing countries, are swapping out of dollar debt to cut borrowing costs, and they're resorting to issuing Chinese yuan or renminbi bonds, or sometimes even Swiss francs, because they cost less.
Mario Ineco highlights that China's bond market is rapidly catching up with the U.S., now the world's largest at around $50 trillion, with China close behind at over $20 trillion and growing fast through government, policy, bank, corporate, and panda bonds. China's bond market is set to expand further as foreign demand for yuan bonds grows, with moves like Fortescue's yuan loans signaling broader adoption. Policy changes to ease cross-border financing show Beijing's commitment, while diversification away from U.S. treasuries may weaken global demand for dollar assets. As more countries issue debt in yuan rather than dollars, global demand for the dollar is set to weaken. Mario believes China's bond market could even overtake the U.S. within the next couple of years, further reducing the dollar's role as the primary reserve and payment currency, especially as Beijing continues linking the yuan more closely with gold.
I want to look at now is the biggest bond markets in the world and why China is really catching up with the United States. So I went to ChatGPT and I asked, what are the biggest bond markets in the world? And it says, just as I told you earlier, and this I knew, I didn't have to ask ChatGPT, it says the world's bond markets are massive, collectively far larger than global stock markets. The biggest ones are concentrated in advanced economies with deep financial systems. As of the latest available data, 2023-2024, the largest bond markets by outstanding debt securities are the United States, 50 trillion in outstanding debt securities. U.S. Treasury market alone is the most liquid and important benchmark globally for now, but corporate, municipal, and mortgage-backed securities are also make it enormous. Number 2, yes, it's China, the second largest bond market, around $20 trillion plus dollars, driven by government bonds, central and local, policy, bank bonds, and a growing corporate bond segment. Number 3, lagging way behind, is Japan, 12 to 13 trillion. Euro area is around 20 trillion, but that's different countries, right? UK is 4 to 5 trillion. And I also looked at how the growth of the Chinese panda market, they call it the panda bonds. I guess it's foreign companies borrowing in yuan. That's been growing quite significantly since 2023, 2024. So it's really catching on. It says here, compared to 10 years ago, i.e. 2015, the market was much smaller. Precise data for 2015 may be less readily available in current sources, but the massive issuance in 2023, 2024 and the 1 trillion renminbi cumulative suggests a steep ramp up. So there you go. That's the panda bonds, panda bond market. So all that's going to mean is that there's going to be less demand for dollars because, yeah, when you borrow in dollars, yeah, you want the dollars, right? So there's more demand for the currency. But if that's changing, and I'm not saying it's going to happen overnight, all these things kind of take a little while. As I said, I started talking about the demise, let's say, of the petrodollar back in 2017. And here we are 8 years later, and it's almost like complete, and it's accelerating. And the same thing's going to happen for the bond markets. And I think it could be a lot quicker than 8 years. We could see in the next year or two the Chinese bond market overtaking the U.S. bond market. And that, in my opinion, will mean that the dollar is going to continue to lose its status as the major reserve currency, even major reserve, a major form of international payment. And of course, I think China is making their renminbi kind of linked to gold a lot, and I'm going to talk about that, of course, with Eric Young. So look out for my interview with him about that. So yeah, let's quickly look at where the markets are this morning. It's 7:30 a.m. London time, so I'm quite early. Spot gold is pretty steady. It's basically unchanged here at 36.43. The low has been 36.26. The high 36.47. Silver is also unchanged, trading at 42.20. High's been 34, and the low has been just below 42. So very quiet markets so far. I expect they will get busier later on. I notice the U.S. Treasury yields, they're creeping up a little bit. The 30-year yield is back to 470. It's up 2 basis points. The 10-year as well is up 2 basis points at 408. Yes, it has come off a bit in the last week or two. And of course, the whole focus this week will be the Fed's decision on Wednesday. It's almost a done deal. They're going to cut by 25 on Wednesday. The news is coming out at 2 p.m. Eastern time or 7 p.m. London. The other thing to watch from that meeting is what they're forecasting, their dot plot chart going forward, and also the press conference. See what is said there by the chairman of the Federal Reserve. So the currency market and stocks are fairly quiet so far.
Will political and regulatory obstacles impede China's bond market growth, or may it eventually catch up to the United States within the next 10 years? If large economies started issuing the majority of their debt in yuan rather than dollars, how might the world's markets respond? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.